right. Hi, everyone. I'm Christina. I'm Christina Morgan from Welch LLP here in Cornwall.
Well, we're starting. See ya.
I'm a partner there, and I work with quite a few real estate agents. So we're here to talk about tax tips. There's a few different things that we're going to go over. Everybody did get a copy of the slideshow? Yes. Oh, we need one? Okay. I had the printer like automatically staple them, so I would have to do it. And of course, it did it in the wrong corner. So you're going to have to just follow along. I want to make sure you're awake this afternoon, go in the right direction. Just to throw everybody off a little bit. All right, so some of the things we're going to go over are eligible expenses whenever you're a realtor, record keeping, what is a PREC, kind of a hot topic right now. Should I make a PREC, should I not make a PREC, when does it make sense? Again, so when to form a PREC, the benefits, and there's also some drawbacks as well. So we're going to go over some of those things, and then I'm going to leave some time at the end for some questions if you have any. Everybody can hear me okay? Okay, perfect. All right, eligible expenses. The question that accountants get all the time, can I write it off? So big thing, right? Realtors, you guys do a lot of advertising, promo, marketing, all of that's a write-off. Your sponsorships, if you're doing the various events, great. If you're sponsoring your kid to play hockey, not really a write-off. You can try to put it through, CRA will probably deny it if they get audited. Meals and entertainment, so if you go taking people out for lunch, you're going to events, you're marketing, trying to, hey, can I sell your house? Or hey, I've got a house I think you'd like. You can write those things off. Those things are tax deductible at 50%, but you can still go ahead and claim those items. Home office, we're gonna get into that a little bit more. I've got a slide that shows you what you can claim for your home office. Vehicle expenses are another one. Internet and cell phone, so CRA says a reasonable use. We've had some people kind of go under audit for internet and cell phone use. I've had one CRA agent go to the extreme and ask for call logs and ask me to actually highlight all the calls that had to do with business and then divide it by the total minutes to figure out the reasonable percentage. I wrote back saying, okay, I'm not doing that, but what I will do is I will pick 1 month at random and do it, and you can extrapolate that for the whole year, because I'm not doing it for the full year. And CRA actually wrote back and said, okay, that's actually pretty reasonable. And so they actually end up auditing this one person every year. So every year we pick a new month and we're like, oh look, it's still about 70%, imagine that. So just little things like that. If you are claiming cell phone internet usage, just remember, if you are ever audited by CRA, what's a reasonable percentage, right? Because you could go your whole life not being audited and all of a sudden you're audited 4 years in a row. So just keeping those things in mind. Donations, so when you're a sole proprietorship, those get deducted on your personal tax return as a tax credit. When you're PREC, and we'll kind of get into that, it's just basically a write-off like advertising and promo. There are some credits there as well. Interest, you can write off your interest on loans that have to do with your business. So your car loan, for example, you can write that off within your business. It is limited, but you can write that off. If you keep everything in a certain bank account and you incur monthly bank charges, you can write those off as well. If you have interest you've incurred on debt with CRA, CRA says you can't deduct that. You paid me $500, but you can't claim it as an expense. Do you want to pass this around too? So just keeping that in mind, bank charges, interest, all good, just can't claim any interest and penalties you pay to CRA. Comes out of your bank account, can't deduct it for taxes. Office furniture and equipment, so you buy yourself a home office desk, printer, you've got went to Staples and had a little shopping trip there. If you bought yourself a laptop, all those things are tax deductible. If you are, pardon?
Like what's the year? Like how much can you?
Well, how many computers are you needing for?
Well, that much.
Again, you need to be able to justify it to CRA, right? So like if you go through 2 laptops in a year, well, things do happen. You may have been working and you spilled you spilled coffee on your laptop. Like I know there's been some years at work where I've gone through 2 laptops and then I've had another laptop that's lasted me like 4 or 5 years, right? So it's always like within reason. If you're going to push the boundaries, there's some people, I've kind of got clients at both ends of the spectrum, really conservative, some that really push the boundaries, and I'm kind of like, okay, well, you're the one that can have the call with CRA. And then you kind of want to be in the middle, right? Like, all within reason. So salaries, whether you're a sole proprietorship or a prep, you could still have people working for you, right? There's some real estate agents in here that work in teams. There's some that work on their own, but you may have to pay an assistant. Maybe you're paying, somebody to help with marketing. You're giving them, part-time wages. You've got a summer student. Hey, I want you to do my Facebook page or your Instagram or whatever for the summer, and you're paying them. You can still deduct all of those things as long as they're also claiming it on their side. So we want to set them up properly. Professional fees, so legal, bookkeeping, accounting, all those things you can claim. Legal fees have to be, within your business. If it is legal fees because you're fighting your ex-spouse for something, not tax deductible, right? So it has to be related to the business. Travel. So a lot of people are like, oh, Christina, I really want to go the East Coast. How can I write it off? I'm like, is there a realtor convention going on? Can you pop by and have some meetings, right? So CRA says you can have 2 conventions a year as long as they're business related. So keeping that in mind, if you are kind of looking to go somewhere, what can I do to make this a business trip? And then make it 2 good ones a year that you can write off. Training and education. So those types of things too. People are like, oh, I took this course, can I write it off? Yes, you can. There's certain courses where you are gonna get what's called a 2202A, an actual tuition slip. Those ones get claimed as a tax credit on your return. But if you're doing like these little online courses where you're paying $500 to do these, you can claim all those things. So we're gonna get into the home office. People are like, how much of my house can I write off? What things in my house can I write off? I put on a new roof, can I write it off as a realtor? No, but there's certain things you can, right? So you wanna have, again, you have to be able to sell your story to CRA. That's what it kind of comes down to. So if you have a home office set up and it's about 150 square feet, your house is a total of 2,000 square feet, you are eligible to claim 7.5%, okay? 7.5% of certain expenses you're able to write off. So 7.5% of your property taxes, mortgage interest, insurance, water taxes, heating, electrical. If you had a hot water tank rental, you could also take 7.5% of that. If you have maintenance and renovations, you can only claim the ones that are specifically related to your office space, okay? So for example, I had a client who put all new flooring on their main floors, which included common areas and their home office. So we said, okay, out of all the flooring that you put down, what percent related to the office, what was really for personal use. So then we claimed, the percent that related to the home office area. So then at least they were able to deduct some of that. You repaint your home office, you put a new door, you put new windows. Well, that's the window for the home office, So as long as it's reasonable and you're claiming it for that portion, you're not gonna go and claim 7% of your roof. CRA is not gonna allow that, right? There's certain things that are within reason.
Is there a max, like 30%? What would be a max?
Well, it's based on square footage.
Okay.
So you would have to show, and the CRA has gone as far as asking for floor plans to prove percentage.
So normal house, about 1,000 square feet, normal office could be 300, so 30%, is that
It depends. I have some people that kind of have like a bachelor type situation, and really half of their area is their home office, right? So it really depends on the situation. But then in that case, their expenses are a lot lower too, right? Bigger house, you're gonna have a smaller home office allocation, but you've got more expense. So smaller area, at the same, you're gonna kind of come to the same thing at the end, right? Vehicle expenses, again, it's based on actual use. So what CRA wants you to do, again, there's like the very conservative, the I'm never gonna track everything, and then there's the in-between that CRA is kind of okay with, Vehicle usage. It is based on total mileage and business mileage. So CRA wants you to track down every single thing you do for business, and they want you to take your mileage at the start of the year, mileage at the end of the year. Said, okay, this year I did 20,000 kilometers. Per my travel log, 10,000 of it was related to business. I went to all of these, open houses. I checked out all of these properties, went to all of these other meetings, and it was about 10,000. So CRA wants you to actually make a mileage log to track all that. I have some people that do, I have some clients that have downloaded apps that every time you get in your vehicle, you say if it's business or personal, and it tracks it and makes a report for you at the end of your calendar or fiscal year. So there's those options as well. And I have some clients that are like, I can come up with a log if I get audited. So, you know, there is, yeah.
That wouldn't have to work.
Yeah, so, you know, there's kind of that in between. CRA is pretty good with that one most of the time. There's certain things they really harp on more than others. If you go and expense a really large vehicle, then they're gonna start to look at usage that way. So some of the things you can write off, you know, you're writing off your insurance, your loan interest, but your loan interest is limited to a certain amount, like a prescribed amount. So if you have a crazy car loan where you're paying 15% interest, chances are it's gonna get drawn down by how much you're allowed to claim. It's all calculated within the tax program. Repairs and maintenance on that vehicle. Repairs and maintenance would also include, like, if you're changing tires, and that's it, you know, tires are super expensive now. It's like $2,500, right, to go change your tires, especially if you're putting on winters. Well, that's repairs and maintenance. That's a write-off, right? Parking is actually deducted at 100%, because if you go and park somewhere for business, well, it's not like 50% of that was personal. It literally went, you know, to a business meeting. So parking, you can deduct at 100%. Licensing and registration fees, your fuel at whatever, again, your eligible percentage, lease costs and amortization. So if you are leasing your vehicle, you can write those costs off as well, but the leases are, the lease amount is limited to a maximum that gets updated by CRA every year. Amortization, we won't get too in depth on here, just because we are limited to time, but whenever you purchase a vehicle, you can put it, you have to capitalize it, and you write it off slowly over time. So that's amortization. For tax purposes, it's called CCA. When you purchase a vehicle, if you go and, if you're trying to write off like a super expensive SUV or like a sports car, they're not going to let you write that thing off in your business. It gets actually limited to $37,000. So if you have a pickup truck and you have a hitch in the back, and you're like, I also help my clients move, and then we capitalize it as a class 10 vehicle, then we can write off more of that. So the type of vehicle you buy also matters. It does help CRA if you've got a logo smacked on the side of your car too. People they like to see that. And they also are more lenient towards expensing vehicles within your business. If you say, hey, my spouse drives this vehicle and that's what we use for personal, and this is what I use only for business. I don't let anybody in this car. It's only me during business hours. This is my family vehicle. So if you have two vehicles, then it's a lot easier to justify all of your expenses kind of surrounding with the first one. So record keeping. This is a big one. So whether you're a sole proprietorship or if you're a prec, you want to make sure that you maintain really good records. First of all, it's going to make your HST returns a lot easier. If you are tracking everything, whoever is doing your taxes at the end of the year, whether it be you, your accountant, bookkeeper, whatnot, it makes it a lot easier for them. It's easier for people to file your HST returns, your corporate personal tax returns. You save money, you know. Accountants, we bill based on time. If I have spent 4 weeks just trying to figure out your personal tax return, that's going to get expensive, right? But if you have kept really good records, you've kind of summarized your information, or you've worked on a system to get the information from you in a clear and precise manner, then it's going to keep those fees down as well, right? You got to kind of help each other out. And then again, you want to make sure that, hey, whatever you deduct in either as a sole proprietor or a prec, that you have backup documentation that you retain for 7 years minimum. Retain it for 7 years in case you are subject to an audit with CRA. Say you're 3 years behind in records, okay, and then all of a sudden you're like, well, I only have to keep this for 7 years, it's way past. Well, if CRA, you kind of want to go 7 years to the day that CRA has processed it, right? So if CRA has just processed 2022 and 2025, that's when you start, you know, the clock for keeping those documents for the 7 years. So things you want to make sure you're keeping. You want to keep all of those commission statements. Luckily, you know, a lot of you, everything is digital now, so you can go back in your emails and get those. But that commission statement that has the breakdown of, okay, what were my commissions? What were the fees that were taken by my brokerage? How much HST did I collect? How much HST was charged, right? And then you get paid the net. CRA likes to have a lot of HST audits. We've seen some for real estate agents. And one of the things that they do pick on, and really doesn't have like an effect at the end of the day, but they like to see a reconciliation on, is whenever you get paid your commissions, you get paid the net, right? After your brokerage takes away the fees, people like to take that net amount and say, that's my sales. No, your sales are what those commissions were, and then you have an expense, right? So they should kind of be recorded as two different items. And you should be showing your sales at gross on your HST returns, on your personal tax returns, PREC. And that's why a lot of the times you'll get that T4A from your brokerage. It says, hey, you made 100 grand. And then you take a look at your sales and you're like, oh, per my HST returns, I made 80 grand. It's because you didn't account for that 20,000 that was taken in those brokerage fees, right? So now your HST returns don't match to your T4A that you got, and that's what CRA, as soon as they see a discrepancy there, they're like, maybe we should audit this person. You know, there's something that's not jiving there. So that's why you want to make sure whenever you're filing those HST returns that you are filing at the gross and you're maintaining all of those documents. So if you are subject to an HST audit, you can show those items. You want to keep all your receipts, obviously, for your expenses. CRA, yeah.
The receipt part of it, like I have an app that you scan your receipt.
That's great.
That's good. So
yeah.
You don't have to have the paper as long as
if you have them all electronically, it's honestly easier for everybody.
Okay.
Yeah. As long as you like save them, as long as that app kind of saves them in a database somewhere, kind of makes them all to PDF, and then puts them in some sort of like chronological, or labels them properly. Because if like when you go and scan something at a printer and it's like scan XYZ 4568, if they're all named that's not going to help anybody out, because we're going to spend So as long as if you are doing everything digitally, come up with a naming system to save all those things, because if not, if and when you ever get subject to an audit or you've got to give your accountant your information, they're going to go, I'm not opening up these 400 tiny little receipts to figure out what they are, So you just want to make sure that it's documented.
It's actually like an accounting software.
Perfect, yeah.
That's actually free.
Yeah.
It's called Wave.
Yeah, I've got some clients who use Wave. There's different levels to Wave. There's like a free version and then what you pay for.
I have the bid, but for the scanning,
and it's pretty decent.
Pay, but it's super easy, but the scanning is nice for that.
It is, yeah, and it actually shows what it is and puts the dates, and that is nice. So your receipts for your expenses, home office. If you are claiming home office, then make sure you're keeping that mortgage interest, sheet, your property taxes, all those things that you claimed. You want to make sure you keep copies of those things. Vehicle, if you have your vehicle purchase documents, make sure you're keeping a copy of those purchase documents with your records and all of the fees associated with it. Capital asset additions. So those, for realtors, your capital asset addition. I have some realtors that have purchased trailers to legit help their clients move. So those are capital assets that we've set up in their business. You're looking at your office furniture, your equipment. You've got some of you that will go buy really expensive drones to kind of do these big aerial shots, right? So those things are they're capital in nature, so just make sure that you keep those receipts as well. And if you do have professional fees. So CRA has these little targeted audit programs, one of them being professional fees, because they want to make sure that you're not trying to expense the fact that you're trying to pay your ex-spouse, for a child support or something. They want to make sure that all of the legal fees associated that are claimed in your business are actually associated with your business. So that is a targeted program where they'll send out a review letter and say, hey, we saw that you claimed so much in professional fees. We want a list plus copies of all the invoices to see if they're actually tax deductible. So the big question and kind of the hot topic right now is, what is a PREC? Should I make one? Does it make sense for me? So as everybody's kind of aware at this point, in 2020, it came out with these personal real estate corporation PRECs. So now the real estate agents could finally have their own corporation, much like other people. You've got the doctors, dentists, physiotherapists, everybody's got a professional corporation. The real estate agents were not allowed to incorporate before that. So there are some advantages with it, and I did put a link, so there is like a blog kind of on it, so you can read a little bit more about the formation of a PREC, but we're going to kind of get into why should I have a PREC, right? So a PREC, remembering that the PREC is a corporation, and then you are the realtor. So the big thing here is two separate things, okay? It is not one and the same. You're the realtor, and then you own the PREC. So whenever you have a PREC, you want to work with a lawyer and an accountant to make sure that you set up the prep properly. The setup of somebody's prep is going to be different depending on your situation. You have a spouse that doesn't work, they do all of your admin work for you actually and are pretty involved in your real estate business. I'm going to set up your shares a little bit different. You are single, not married, never want to get married, well, your share structure doesn't have to be as complicated, right? If you have young aspiring realtors in your family and you're thinking, you know what, I think my kid might want to be a real estate agent like me one day. You know, there's different things that you want to consider whenever you're forming your prep. The reason you want to do this is because, again, you're the realtor and then there's the prep. You own the shares of the prep, okay? So you own the prep. You two are two separate legal entities. So depending on how it's set up, there's different classes of shares, voting, non-voting. You want to make sure you have control. The real estate agent has to have voting control of the prep. You can bring in minority shareholders that are not real estate agents to be able to income split with. The thing is, those individuals need to be involved in the business. So if you bring in a spouse who's got $150,000 T4 coming from wherever, and you're trying to give them half your income, Siri's going to say, I don't think they're working for you, you know? So you want to make sure that if you are setting up somebody as a minority shareholder and you're looking to do some income splitting, that they are actually involved in business, maybe helping you out admin side, scheduling, whatnot. So yeah, so voting, whenever you are a prep, you're like, okay, well now all the money is going to the prep. How do I get it if I'm separate? So the way that you get money out of the prep is through two forms. You either salary and or dividends. I like to give my clients a combination of salary and dividends whenever they have a prep because there's certain advantages to having a little bit of both. Whenever you have a salary, there is an employment tax credit that you get, and then you're writing off you have to contribute to CPP, so then you're writing off that like within your corporation. The other thing is whenever you have dividends, there's also a dividend tax credit. So there's kind of like a sweet spot where, okay, I'm gonna take so much in salary and then I'm gonna take dividends after that in order to come up with the total compensation that I need for my prep. And that whole theory is the theory of integration. So integration being, okay, your prep is getting all the money. You're putting all your expenses through the prep and then you're paying corporate tax. After what's left, how do I get it? I take it in salary dividends and then I pay tax on that. So you pay your corporate tax first and then you pay your personal tax on what you take out of your prep. So I'll kind of get into more of that. So sole proprietorship, if you are a high income earning realtor and you're making over $253,000, you're paying income tax at the rate of 53%, which is very high. Your tax payment is due April 30th, but you actually have until June 15th to file before having any late filing penalties. Anybody with a business return is June 15th. Whenever you have a PREC, the PREC, assuming you qualify for the small business deduction, which you have to be Canadian, you're a resident here, blah, 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 the corporate tax rate is 11.5%. So remember, 11.5%, but this is before you take anything out. So that is leaving everything in the PREC. You have not taken anything out of the PREC in compensation, right? So the PREC pays tax at 11.5%, which is much lower than your 53. You can choose any year end. So your personal taxes is January to December. Whenever you're a PREC, you pick your year end. So I've got a lot of PRECs that are like June, August. We kind of pick a year end that works. What I like to do is pick a year end, so your corporate taxes are due in the fall, and you pay your personal taxes in the spring. So we can kind of tax plan around, we can move things within a year because your fiscal years will straddle to calendar years. It gives you a lot more room for tax planning, and then you're not paying both at the same time, right? You're spreading the love, so corporate tax in the fall, personal tax in the spring. Your corporate taxes are, CRA will start to charge you interest 3 months after your year-end date, but you have up to 6 months to file. And then whenever you take the money out of your PREC, that's what you report on your personal tax return, and you pay tax at that personal level. So I'll kind of show you how that works, when it makes sense to actually have a PREC, since you do need to eventually take the money out and pay tax on it anyway. So So as I kind of already spoke about, your compensation, sole proprietorship, whatever's left at the end of the year, that's just your spending money, right? That's what you use. Whenever you're a prec, it's what you take out of the prec, either form of salary and dividends, and what's left after you pay your personal taxes. So should I incorporate? There's a lot of factors that come into play. Do you need all the cash? At the end of the year, are you sitting on a load of cash that you haven't spent on stuff? Probably an indication that you should incorporate. If you're like, man, we just made it by, you know, we are on budget every month, I am spending all the money I'm bringing in, probably not going to be beneficial for you. How many people contribute to your household? If you have a partner who brings in a good amount of money as well, and you don't need to use all of your income from your real estate business in order to fund your family, then those factors come into play as well. Do you have a spouse that assists you in the business, right? So maybe your spouse doesn't work, but they're working as admin, they're doing your marketing, they're updating your Facebook, you know, they're working in the background with you. Well then, you know, there are some tax things that we can do there if we do bring them into the business and put them as a minority shareholder. If you do have excess cash, are you trying to invest it in properties and different things, right? And then, you know, when you do have a prec, there's a lot more record keeping that needs to be done. So are you going to keep up to date with your record keeping? Because you have to keep track of. Now, whenever you're a sole proprietorship, you're just keeping track, oh, here's my income, here's my expenses. I pay tax on the net, right? Whenever you're a prec, you have to actually report a full balance sheet and income statement to CRA. So you're showing them, I've got cash, I've got income, I've got commissions receivable, I put a deposit on a property, that's a prepaid expense. Oh, actually I set up this trailer, there's all my assets. Oh, liabilities, I'm gonna owe the accountant for telling you all this. I have a loan on that trailer, right? And then you've got to show them that full balance sheet and income statement, but you have to reconcile and keep up to date with those records on a monthly basis. All right, so we're gonna go over 3 scenarios. And I wanted to show it at the highest rate of personal tax so you can see kind of when this starts to make a little bit more sense. I'm not saying that you need to be at the top tax rate for it to make sense, but I just wanted to use this example. So scenario 1, 2, and 3, we're gonna go over 3, and I'm gonna say you net out $260,000 at the end of the year, okay? So you had $300,000 in commission revenue, you had 40 grand in expenses, your net income is $260,000, okay? You are set up as a sole proprietorship. After you pay your federal, provincial taxes, and you have to pay into CPP as a sole proprietorship, you are left with $158,000 on that $260,000. You have paid almost $102,000 in taxes. So that's scenario 1. Scenario 2, you're like, you know what, I'm paying crazy tax, that's it. I'm putting this into a prep, but you spend it all. You don't leave money on the table, right? So you're like, okay, I'm gonna put it all in the prep, but you're taking all the cash out of the prep because maybe you're the main income earner for your house. Maybe you guys bought a cottage. Somebody got sick, you're helping to support somebody, right? So you're taking all the cash out of the prep. So the prep, that net income is $260,000. I have set you up on say I was your accountant, I set you up on a salary of $90,000. So this here, salary and employer CPP. So again, that CPP comes into effect. So I want you to see that. So $94,000 in salaries expense is what? So I've given you a $90,000 salary plus you're paying into your CPP. So $94,000 expense comes out of that. Now my taxable income in the corporation is $165,000. Corporate tax rate's 11.5%, which is beautiful. I pay 20 grand in taxes. Amazing, right? But then I go and I got $145,000 in the bank account. I take it all because I need it for, you need it to fund your family, that cottage, that sick relative, whatever, but there's no cash left in the corporation at the end of the year. You're left with $700 because you've taken everything out because you need it in order to survive. So you take that $90,000 T4 from your prec and you've got dividends from your prec. So I've given you $90,000, $145,000. Basically you've pulled out $235,000 from your prec on the original $260,000. Kind of makes sense. You've got that CPP, you've got that $20,000 of corporate tax you've paid. With that $235,000, you're paying another $78,000 now in tax, and so you're left with $156,000 personally. So out of that $235,000, You're gonna pay some tax, you're now left with 156, okay? So if we combine that, and the PREC, you were left with 700 bucks, and then personally, you were left with 156, 200, so now you're just under the 157 mark, okay? At the end, I'm gonna show you all three and how they work out. So scenario 3, this is a scenario I like. This is what we tax bank for. You're like, okay, I cleared 260, I only need 175 in order to fund my lifestyle and contribute to my family, okay? So again, it's the same thing. You're gonna pay 20 grand in corporate taxes like we've already seen. But then when I give you a dividend, I only need to give you an $85,000 dividend to bring you up to that 175 that you needed. I've given you a $90,000 salary, and I've given you an $85,000 dividend, so your total income coming from your PREC is 175, okay? So in the PREC, now you're left with 60 grand, which is much better than the original 719 bucks. When you file your personal tax return, you're now paying tax on a T4 of 90,000 and dividends from the PREC of 85,000. Taxable income, 175,000, just as we planned, right? Your personal taxes, 52,000. You're left with 122 at the end, personally, okay? So now, left in the PREC was at 60 grand. Left in your personal bank account, you've got 122 grand. The total you got out of there is 183,000. So whenever we compare the three scenarios, scenario 1, sole proprietorship, you just pay tax on whatever's left. Out of the 260,000, you end up with 158. It's about 61,000. You set up a PREC because you think it's a great idea, but you know what? You take all the money out and you spend it because you need to, right? And that's fine. You actually end up with less cash, more expenses, because, and we'll kind of get into that when we get into the cons of a PREC, and so you only end up with 60% of your original 260,000. So you think a PREC's a good idea, but if you're spending the money, it's not. Scenario 3 is the one where it makes sense to make a PREC. You don't need all the cash. You know, maybe you've got a spouse who's bringing in a good amount between the two of you. You don't need to pull it all in order to fund your lifestyle. So you end up with 183,000 out of that original 260. So you're retaining 70% of that original 260. So that's where it makes sense, okay? So it only makes sense to form a PREC if you're going to leave some cash in the corporation. With the PREC, it's an opportunity to take advantage of tax deferral. So you're leaving cash in there, right? And the idea is you're going to take that cash, you're going to invest it, or you're going to do more with it, and later on you can kind of use it as a retirement vehicle, right? So now you've built up all these assets in the corporation, you're done being a realtor, or you're just kind of doing it part-time, right? You're taking less, your T4 from your corporation isn't as much anymore. We're not giving you these big dividends because you're not trying to pay for your kids' hockey trips and all those things, right? And now you're at a lower in a lower tax bracket, and just slowly kind of peeling some of the assets out of the corporation later on in life when you're at a lower tax bracket, right? So you're earning all the cash now while you're in that higher tax bracket, but then you're pulling it out later. So you're deferring that tax and you're paying a lower rate of tax on that money later on down the road. So other benefits, and I kind of just alluded to this, and I know we only have 10 minutes left, so I've only got like 2 slides left. So you want to take your excess cash, you can invest it, GICs, stocks. A lot of people like to GICs. The interest rates really aren't that great. I would say, talk to an investment advisor who can put you in some stocks that have some really good long-term capital growth, if that's the way you want to go. You can lend out some money at some high interest rates, right? You guys know a lot of people that are trying to borrow money to buy things. So there's some opportunities there to do some loans as well. I have a lot of realtors who purchase rental properties because, hey, you guys know when they come on the market before anybody else, you're like, you know what, I kind of like that over there, and I don't have to pay myself that commission. So I do see a lot of realtors who will invest in rental properties, and I've had some realtors that have done it and like, why did I ever do that? I hate being a landlord. I don't understand why people do this at all. So just keep that in mind. That's a whole side part, but just keep that in mind before you become a landlord. So you can diversify your income within the PREC. You know, you can have property management, you can have investment advisory services where maybe you're kind of providing advice to potential clients on what type of properties they want to look into, want to invest in different projects, and real estate development as well. One nice thing about the PREC is a lot of people actually purchase their vehicle and set it up as an asset right within the PREC and say, okay, I've got my truck in the PREC. This is my business-only vehicle. I've set it up as an asset here, and then my spouse has, you know, the Honda Civic, whatever. This is our family car that we take on the weekends, and you're writing off 100% of that truck. So that's what people, it's a nice benefit there. Corporate tax rates, and then also corporate rates for financing. Sometimes if you're trying to get loans for certain things, it is cheaper within a corporation, but you can kind of look at both situations. Asset protection. You've got a beautiful home, you've got a cottage, you've got all these other things personally. You have some sort of bad real estate deal and somebody tries to sue you. Well, they're limited to the assets within your PREC. Okay, they can't go after your personal home and those things after. I already mentioned how you can use it as a retirement vehicle. Timing of tax payments, you know, you choose your year end, you can kind of pay your corporate tax at one point, your personal tax at another point during the year. Income splitting with your spouse, if you have your spouse as part of your business, is another nice one in the PREC. You could set your spouse up as an admin and put them on payroll under sole proprietorship as well, but it drives a lot better in the PREC, and then it also gives opportunity to do some dividends as well to different levels of shareholders. And intercompany loans, if you want to set up a holdco and move all your excess cash into a holdco to start buying up different types of properties. Sometimes it makes sense, sometimes it doesn't. You know, you want to kind of check to see if it makes sense at that time, but you can loan money tax-free to your other companies because it's basically just the same pair of jeans, two different pockets, right? You're just moving one to the next, and that's kind of the way CRA sees it. So you can just move money from one port to the other, assuming that you have the ownership. Some of the drawbacks is you do have upfront incorporation fees and legal fees every year to maintain your minute book. Those with a PREC, you're kind of like, oh, what's a minute book? You should be maintaining it every year, but what normally happens is nobody goes and maintains your minute book until CRA says, hey, is your minute book up to date? You've got to do 6 years worth. But really, you should be maintaining that minute book every year. The lawyers are kind of getting more on it because they are not happy with having to do like 10 years of minute book updates. So now we're getting the emails all the time from the lawyers being like, hey, we need to know what happened at the year end to maintain the minute book, so they're getting up to date on those. Your accounting fees, those are a lot higher as soon as you're a PREC as well, because you have to report that full balance sheet, making sure that everything is reconciled on a monthly basis, and filing corporate tax returns. There is increased complexity with your record keeping. As I kind of already talked about, you're subject to a little bit more CRA review. If you have investment income within your PREC, it is not taxed at 11.5%. So passive income, investment income, is called active investment income, so AII. So if you have rental properties having rental income, that is not business income, that is passive income. If you invested and you have interest, dividends, you lent out some money, you got interest on a loan, that interest, that is passive income, and that is taxed at the higher rate. It's about 50% until you get issued a dividend, and then you get a dividend tax credit, which brings it down to about 27%. So if you're kind of in the 40-50% personal tax bracket, still makes more sense to have those investments within your corporation versus holding them personally. And there's some other benefits there as well. If you have a lot of passive income in your PREC, then you do get a grind down on what they call the small business deduction. So you pay 11.5% tax in a PREC because you have access to the small business deduction. The more passive income you have, they kind of ground that down to where you would get to a max paying about 26.5%, so around that 27%, which again could still be a lot lower than what you'd be paying personally, right? So there's times where it makes sense to hold things personally, throw things in a PREC, a holding company. You'd want to take a look at all those situations. If you are married to a realtor, you cannot have one PREC together. You each have to have your own. You're only allowed one real estate agent per PREC, which is devastating because it would be nice to kind of do that income splitting with spouses that were real estate agents. And volatility of the market. I've had some real estate clients who have like done amazing one year and we're like, oh my God, all this excess cash, what are we gonna do with it? How are we gonna invest? We're in a tax plan. And then they don't get anything for 6 months. And they're like, well, I just spent it on living, right? So the volatility of the market, as you guys know better than anybody else, has been kind of crazy. Some people have been very fortunate to stay very steady. Some people have been all over. Some people just keep getting these massive deals and then nothing, the massive deals and then nothing, right? So it's really hard to tax plan sometimes and budget just because you guys don't get the same income on a weekly basis. And even if you set yourself up on a salary, you may have a month where no commission's coming. So you may say, hey, I'm not gonna take salary for my prec this month. I'm just gonna hope that check comes in soon and I, get another big deal going. So it may make sense to make a prec after 1 year, but then if your sales go down the next year, it doesn't really make sense all the time. So you wanna have a few good years and really make sure it makes sense first. All right, almost at time. I do have some time for the questions if anybody has any. Yep.
If your vehicle is in the crack, you can claim 100%, but do you still have, can you just have the mileage at the beginning and end of the year, or do you still have to keep a log?
It's a lot easier within so if your vehicle is within a corporation, when CRA issues a vehicle audit, we're a lot more lenient. If it is in a sole proprietorship, they seem to really demand those logs. If it's set up in the prep, normally anytime a vehicle is set up in a corporation, there's a vehicle audit, they just want to know how many kilometers do you use it, they want to know how do you use it. They want a description of the vehicle, a copy of the vehicle purchase, and they want to confirm that you have another vehicle that you use personally. I have not seen them ask for a log within a corporation in a while. When they do ask for a log within a corporation, like they're on a mission, but it's been a while. I've seen a lot of vehicle audits and I've not seen like them ask for the log in the corporation in a while. Yeah. There's always a chance they could ask for it, but I haven't seen a lot of that. Yep.
Is an old vehicle has to be on your personal name, or it can be under your wife's?
The second vehicle, it can be under it can be under your wife or your name personally. It doesn't matter. You can just say, I've had both situations where it's like, oh, my wife has the SUV. This is what we drive on the weekends. So as long as it's not owned by the prec as well. If you put all your vehicles in your prec, CRA is going to deny, and they're going to say you are allowed one realtor per prec. You are allowed one vehicle. Yeah.
But you get seasonal cars, you get your summer car and your winter car.
Yeah. So I've had some people try that one too. Yeah. Yeah.
That's what that's the choice.
So for that one, but during the year then you're still kind of expensing one vehicle, right? CRA would probably say a percentage of use at that point. In order to set up a vehicle within your prec, you want the use to be 90% business. If it's not 90%, if really you're like, I don't use my car 90% for business, then that's when you track your mileage and we actually do a mileage rate. So I do have some real estate agents that we've set that up for, where we just, okay, track your mileage for the year. You had 1,000 kilometers. The max mileage rate per CRA is 60 cents. We're going to give it to you that way, and then we credit it to your shareholder account, which is a whole other.
With the prec, I've heard chatter that you can borrow personally and pay it back within a year. Does that apply to?
So that's the whole thing with dividends. So it's not really borrowing. Basically, you have what's called a shareholder account. Everything that you take out of the prec that is not in the form of salary that goes to your shareholder account. Or if you pay for things that are really personal in nature, go to your shareholder account. At the end of the year, if your shareholder account is in a debit, which means you have taken out more than what you've put in, and technically it's a receivable to the corporation. You owe the corporation money that you've taken out. We issue a dividend to clear that out. If you could go 1 year in a debit, you cannot go 2 years. So it's a slippery slope to play that game, because if you keep up with that habit of siphoning money out of the prec and not paying tax on it, it's going to cost you a lot more the next year whenever you do a dividend to clear out that debit, because now maybe the first year you took out 50,000 that we left there because you're like, oh no, I'm gonna figure it out. You take out another 50,000 the next year. Well, now you're paying tax on 100 grand versus 50 and 50, which would put you potentially at 2 different tax brackets, right? So it's costing you more in the long run. So I don't like to have my clients in a debit position unless it's really small, and I always clear it out after year 2.
You had the example like 260. Is that like you calculated, was that be like a sweet spot, or is it?
No,
like,
so
okay.
So I used 260 just because that put you at the top tax bracket, so it kind of was a more dramatic effect then. but it really depends on your situation, because you can make 200,000 and need it all, or somebody can make 200,000 and only need half, right? Like, it really depends on your situation. Do you have somebody else contributing to your household income? Like, there's a lot of factors, so you need to look at your budget. The biggest tell sign, if it makes sense to make a prec, am I sitting on cash at the end of the year? Do I have all kinds of cash to play with? Was I able to buy all kinds of toys because I was just sitting on cash? Well, maybe it would be smarter then to set up in a prec and take that extra cash and invest it instead of spending it. But if you're just going to keep pulling it out, buying the toys or playing, or if you just need all the cash because you are the main income earner for your household, probably doesn't make sense. So it's not really necessarily a sweet spot when it comes to volume. It really depends on your situation. Who else is contributing to the household? How many people depend on your income? If you are supporting your entire family, plus you're taking care of a sick parent and whatnot, and you are supporting everybody, probably doesn't make sense to have a prec because you're going to be using it all anyway, right? But if you've got that excess, you've got somebody else contributing, then it makes sense. Okay. Any other questions?